Right now, Iran says it has targeted U.S. military facilities in Kuwait and Bahrain, and oil traders are watching the Persian Gulf closely. This matters far beyond the region. It can affect energy prices, transport costs, inflation expectations, and the markets many people see in retirement accounts. In this briefing, we will separate what is confirmed from what is still a claim, explain why the Strait of Hormuz matters, and identify the signals that could move oil and markets next. Welcome to Capital Capacity Brief, where we track the news that moves energy, markets, and household costs. This is market context, not personal financial advice. First, the confirmed framework. On Friday, Iran's army said it launched attacks on strategic U.S. military assets in Kuwait and Bahrain after a fresh U.S. wave of strikes inside Iran. In Kuwait, Iranian state media said drones targeted aircraft shelters, satellite communication systems, and equipment storage at Ahmad el-Jaber Air Base. In Bahrain, Iran said it targeted facilities at Sheikh Issa Air Base, including power generators, navigation systems, and support buildings. The key word is said. These are Iranian military claims. They are not independently verified battle damage assessments. In a fast-moving conflict, the difference between a claimed strike, an interception, and confirmed damage is material. The timing matters. U.S. Central Command said U.S. forces had completed what it called a heavy wave of strikes against dozens of Revolutionary Guard targets in Iran. This is not an isolated event. It is another exchange in a wider cycle of escalation, retaliation, and competing claims. There is also a separate development in Egypt. Egyptian authorities said preliminary findings showed a drone caused a fire on 2 vessels at the Mediterranean port of Damietta. The fire was brought under control, and no party had claimed responsibility at the time of reporting. The drone cause is confirmed by Egypt's cabinet. Who launched it is not. But a disruption at a gas and energy hub expands the market's concern beyond the Gulf itself. So, why should someone filling a car, planning travel, or checking an investment account care about these events? The answer is the Strait of Hormuz. Before this war, roughly 1/5 of the world's oil and gas trade moved through this narrow waterway. It is a physical bottleneck connecting Persian Gulf producers with global buyers. When risk rises around Hormuz, the market begins pricing several things at once. Fewer ships moving, longer routes, more expensive insurance, higher freight costs, and the possibility that disruption lasts longer than expected. Those costs do not automatically become higher prices at the pump on the same day, but they can feed into crude futures, refined products, airline costs, shipping costs, and eventually wider inflation. The latest market snapshot must always be time-stamped. On July 31st, West Texas Intermediate traded around $84 a barrel, while Brent traded near $90. Those figures can move sharply in a single session. The important nuance is that oil does not rise on every conflict headline. Prices had recently eased as flows through Hormuz recovered from near standstill levels, although traffic remained well below normal. Traders are weighing 2 possibilities. In a contained conflict, some shipping continues, supply finds workarounds, and the risk premium fades. In a prolonged disruption, more vessels avoid the route, insurance tightens, and physical supply becomes more constrained. Markets can move between those views in hours, not days. To see why the reaction can persist, zoom out from today's headline. The U.S.-Iran conflict began in late February and has moved through repeated periods of escalation, pause, negotiation, and renewed strikes. The pattern has been familiar. U.S. strikes target Iranian military capability or assets connected to shipping threats. Iran, or the Revolutionary Guard, then claims retaliatory attacks against U.S. facilities or regional targets. Gulf governments activate air defenses and try to limit the spillover. For markets, uncertainty is often more expensive than one clearly defined shock. A one-time event can be repriced. A repeating cycle forces companies to keep paying for alternate routes, extra fuel inventories, insurance, and security measures. That is what people mean by a war premium in energy. It is not a magic number. It is the extra price traders are willing to pay because tomorrow's barrels may not move as smoothly as today's. And energy is only one channel. Higher and more volatile fuel prices can influence inflation expectations, bond yields, consumer confidence, airline margins, freight-heavy companies, and the assumptions investors use to value growth stocks. This does not mean every headline produces a global supply crisis. Demand, inventories, emergency reserves, and spare production all matter. But it does mean energy markets are more sensitive to the next escalation than they would be in a normal period. So what should you watch next? First, actual ship flows through the Strait of Hormuz. Watch tanker traffic, insurance notices, maritime security alerts, and whether vessels are moving consistently. Second, watch whether attacks spread to Gulf energy infrastructure or draw more governments directly into operations. A wider footprint can change both the risk to supply and the expected duration of disruption. Third, watch the inflation signal. Energy is only one input for central banks, but sustained volatility can influence inflation expectations and the interest rate path markets expect. Watch the ships, watch the infrastructure, and watch the inflation data. We will keep separating confirmed facts from claims. Subscribe to Capital Capacity Brief for the next update.